Thinking about investing? Don't know whether it's the right time? Well, this video is perfect for you. So, in this video, we're going to be talking about the latest market news, inflation, how a potential recession could affect the property market, the Bank of England interest rates, and of course, mortgage rates. Now we're going to put all of these into a pot at the end, and we're going to have a look at the joint effect that could have on the property market. So let's talk first about the market news. It's negative, right? Now most newspapers are reporting a potential downturn in the property market. However, they've been doing this for years. We've done webinars previously and previous videos on the subject where you can take a negative headline from the last 20 years and it wouldn't look out of place today. Now that's because most of the negative headlines have been rehashed time and time again. However, most people read the headlines without looking behind the facts and figures. So let's take a look at the headlines and let's then look at behind the scenes. So the biggest headline at the moment is the property market is set for a crash, a fall, a dip, whatever you think it should be. First things first, what constitutes a crash? Is it a 5% fall, 10%, 15 or 20%? That's the first thing we need to work out. The reality is, even if the property market fell by 20%, which we don't think it will by the way, we would actually still only be at the same level that we were at the start of 2020. The worst two crashes over the last 45 years were in the late 80s and 2008 to 2009. Now in the late 80s we saw interest rates at 15% give or take, 3 times where they are today. And in 2008 to 9, banks simply didn't have the liquidity to lend, or they chose not to. So what do we think is going to happen? Well, we certainly don't see a crash, and I'm going to explain why. If we look at today's mortgage market, at the time of recording this video, it's at 5%, give or take. Most mortgages have been given over the last few years have all been stress tested up to the 7% mark. So even those individuals who are coming up to renew their mortgage, things are going to be tight of course, but they're still going to be under that 7% mark. So the affordability is actually there. And another factor is that the UK housing market is not actually heavily mortgaged. In fact, it's pretty low. Only 30% of the UK property market is mortgaged. Again, this means that any negative effect on the rising mortgage rates is going to be substantially decreased. Because the reality is, it's not going to affect as many people as it once would have done years ago. And of course, what we're looking at as well is who is going to be affected by the higher rates. Well, when COVID hit, there was a huge need for space, this fashion. Everyone was rushing out to the suburbs, overpaid for their property and signed up for 2 or 5-year mortgage terms at really low rates. Now it's these people that are going to be struggling. They're really now coming up to have their mortgages renewed, and over the coming months, they're the ones that are going to be affected. Now, if they are going to have issues with paying that mortgage back, they're going to have to take a slight hit on the property because the affordability may not be there for them. But where is this happening? Well, the majority of these properties are in the south, and that's where we're seeing the majority of the decline. But what we have to look at is when we look at the UK property market as a whole, each city has a certain weight on that property market. So for example, if property prices fall in London, that brings the overall price of the UK down quite dramatically. Whereas if property prices fall in a smaller city or a smaller town, it doesn't weigh as heavily on the UK average property price. So you may hear that the UK property price has decreased by 3 or 5%, for example, but it certainly doesn't mean that all of the UK has fallen. Well, in fact, it actually shows that there's a number of cities still in the north that are increasing prices year on year. So overall, we can see a UK average correction of anywhere between 3 to 7%. But as I say, it's a correction. We certainly don't see any major crashes in the market. But actually, in times of despair, like now, you should be using these figures to your advantage. What you should be doing is using the negative headlines, bidding on properties, and looking at off-plan options. Now, we're going to come to these solutions later in the video about what you should be buying and what you should be looking for and what you should be bidding on. But again, before that, let's head to the next item on the list, inflation, interest rates, and more importantly, mortgage rates. So let's talk inflation. It's proved far more stubborn than we first thought. But what has caused this? Well, first things first, that's gone totally under the radar. The Bank of England have swept this under the carpet, but they printed close to 500 billion. That's right, 500 billion pounds during 2020 and 2021. Now, that is a staggering amount of money. So with more money in people's pockets, well, what happened? What did they do? Well, they spent, and they spent big. Add to this the Russian-Ukraine conflict, which drove up energy prices and food prices, and you've got the perfect place for a perfect storm. However, we have since seen energy prices and food prices fall, but we're still left with high inflation. Well, why? Because people are still spending on goods and services because they still have the money. So what have the Bank of England tried to do? Well, they've tried to jack up interest rates to 5.25%, where they are at the time of recording. Now, they hope this is going to budge inflation, but the reality is it's a bit of a blunt tool initially, but they're hoping that the secondary inflation market and wages, etc., it's going to have an effect on that. But they are caught between a rock and a hard place, because if you increase rates too much, you're actually going to cause the economy to go into shock and cause a recession. Not enough, and of course inflation remains stubbornly high. So I feel we may have another 1 or 2 increases in the interest rate, but again, I feel that's as far as they're going to go. As inflation starts to fall, which it will do over the coming months and years, the Bank of England will start to pull back on those rates. And in turn, over the longer term, we should see rates come back to a normal level, albeit not back to the level we've seen in terms of the 0.5% mark. But if we can get back to that 3 to 3.5% mark, we should see mortgage rates come back nicely. Now, when? Of course, that's the million-dollar question. Well, probably over the next year or two. This again means that off-plan property, that's the property that's built in 18 months to 2 years' time, is probably the way forward. But before we go into the options, what do we have next? A potential recession. Now, this can of course be caused by the Bank of England increasing rates too far and too quickly. However, it ironically can be pretty positive for the buy-to-let market. Why? Well, in the reality, the recession causes more people to rent. They simply don't buy, they're nervous, they sit on their hands, and by renting more, they push up prices in the city centres, making the buy-to-let market far more lucrative. So with everything that's going on, what do we have to say to you guys? What is the solution? That's really what you're here for. What is the solution and what can you do about it? Well, if you're a cash buyer, you've got great options at the moment. The first thing that you should be looking at is bidding on the property, because developers are fully aware of the issues with the market at the moment. So you can be buying ready now property or off-plan property, but either way, we can help you get the right amount of discount. And you should be looking at income anywhere between 6 to 10%, all depending on the kind of lets that you do, short-term or traditional. However, if you're looking to get a mortgage with your property, the reality is you probably should be looking at off-plan, something that's say 18 months, 2 years away. Why? Well, with mortgage rates where they are, you're pretty much paying at the peak rate. So you're looking roughly 5-6% for a mortgage. So even if you secure a discount, the reality is that you might be overpaying for your mortgage. So what we say is secure the discount now, get the property now, that actually completes in around 18 months to 2 years. So you're going to be benefiting from the discounts, but also you're going to be benefiting from a lower mortgage rate that's potentially going to come in 18 months to 2 years' time. So it's still a great time to buy an investment property. Use the negative news in your favour, make sure you get the discount and start making money from day one.